Good evening, everyone. I'm Ashish Shanker. I head investment advisory for the private wealth management business. It's my absolute privilege and honor to welcome all of you on an auspicious occasion today to our building. We believe that whenever clients come here, our institution gets blessed. We have a very interesting presentation and a panel discussion lined up for you to take you through the various colors of the budget. And I'm sure you'll find it interesting and insightful. But before I do so, I just wanted to take you through an offering that we have at Private Wealth Management that we believe is a one-stop solution for all your wealth management needs. Now, this is the approach we adopt in our private wealth management business. And our entire advisory framework starts with the investment committee that we have. This committee meets every month to review markets and to take a view on asset classes, which gets expressed through our monthly strategy note, the Alpha Strategist, which I'm sure a lot of you will be familiar with. Now, this investment committee is chaired by none other than Naveen Agarwal, who is our managing director. And we also invite the heads of various mutual funds to give a third-party opinion of what's happening in markets. Now, the second part of this process is to select the best solutions for you from these asset classes. So if our view on fixed income is bullish and we believe that yields will go down, then the job starts to find the best fund that will mirror this view for you. Now, often what we have seen is that this is typically the state of mind of an investor. You have different advisors coming and giving you different types of advice. There are, roughly 5,000 odd mutual funds, and there is a lot of confusion in the minds of the investors. And what also happens is that you end up owning a lot of schemes in your portfolio and are unable to track the performance effectively. Now, to solve this confusion, what we've done, we've tried to bring all of this on a single platform. And this platform is basically called Delphi, where we allow our investors to choose the asset allocation that best suits their profile. So you can, as an investor, select that you want 40% debt, 40% equity, and the remaining in liquid. Or you can choose to be 100% equities, or you can choose a profile that has no equities. Now, we can replicate all of this with a single check. And the underlying portfolio consists of various mutual funds across asset classes. Now, however complicated this may look, I wanted to showcase some of the decisions that we have taken at our investment committee meetings. And that will give you an insight also on how we manage this particular solution. So, whether it was, a decision to, tell people to sell gold in 2013, or, to tell people to get into gilt funds because our view on interest rates turned bullish, what we do is every single piece of advice that has gone out to clients, we document it. Because we believe that often what happens in the market is that, you get different, advice at different points in time. But our experience has been that there has been not too much accountability and transparency. So what we've done is from day one, we've documented every single piece of advice that we've given to investors. So this not only serves as our track record, but this also serves as an insight into our process. The idea is, we're not going to get every call right. We're going to have our misses, but it's important to document what we have advised investors over a period of time. Now, what has this resulted in? So I've just put out 3 of our strategies that we manage. The first one being conservative, where there is no equity. The third one being aggressive plus, which has only equity. And the underlying is basically mutual funds or strategies of different managers in the market. So if you look at the conservative option, which has no equities, even an option like that, if managed well, over a year has generated close to high double-digit returns. Similarly, the equity portfolio has generated a return of 55% against an index return of 41%. And this has come by investing across managers. So we believe that this not only gives you ease of investments, because through a single check, you get exposure to several managers in the market. You also get exposure to the asset class of your choice. You can choose, whether you want to have a balanced portfolio, you want to have a 100% equity portfolio, or, whatever mix suits you. And the performance happens at a portfolio level, because I've often seen that, investors end up with several schemes in their portfolio and, are unable to measure the portfolio performance effectively. Now, having said that, I just wanted to share, and I know that a lot of people sitting in this room have experienced this performance personally, but sometimes what happens is, we keep hearing performance in the form of CAGR. People keep telling us, 18% annualized return, 20% annualized return, but I just wanted to show you what a little bit of outperformance can do to your portfolio over a period of time. So one of the strategies that we manage, this has been managed from 2003, the value portfolio, and this is essentially a collection of high-quality, large-cap stocks. Since inception, since the time we started this portfolio, has gone up 20 times. So an investor who gave us 1 crore in 2003, his portfolio is worth 20 crores today. And sometimes when we, look at annualized returns, we are unable to fathom the impact of 25% per annum return. Now the index during the same time has done close to 20%, which is not bad. But a 8% outperformance has generated twice the capital for you. So if you had invested in the index would have gone up 9 times, whereas this strategy has gone up 20 times. And if the track record continues in a similar fashion, in another 5-6 years, this is definitely going to become 100x from the time this was started. 100x was the subject of, Ramdevji's wealth creation study recently, as all of you are aware. So what we've seen is the returns get magnified over time. Now another strategy which we started at the peak of the market, in December 2007. Now this strategy was started to invest in very high quality, medium and small cap companies. Now, I remember that, the strategy when it started in 2007, it drew down almost 60% of its value in the crash. But even after drawing down 60%, it's multiplied capital 3.7 times since the time it started. So that's the power of compounding, power of investing in very, very high quality companies and staying invested, which is what our house philosophy is. And you see that, the longer you stay, the better it gets. So a small outperformance over a period of time, results in huge, gains in absolute amounts. This is the point actually I wanted to, showcase here. So over time, both these strategies have delivered superior outperformance.